love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning, welcome back to Money Matters. Here we are on a Sunday morning, a rainy Sunday morning. It's 35 degrees. And we're talking about this week in the stock market where we have the Dow Jones down 1,000 points, over 1,000 points, almost 1,100 points, 4.1% for the week. We had gone 99 days on the S&P 500 without a drop of more than 0.6%. Almost 100 days without a speed bump. So I went back and I wanted to bring back the correction history that is so important just to remember, because again, I think of the market as a roller coaster. I think of it as a bucking bronco for some reason. I think it's because I spent a year of my early youth in Cheyenne, Wyoming. And I always have a picture of the Wyoming license plate with the bucking bronco, and I think that's why. But the reality here is that corrections, even though the last 2 years the bucking bronco has been asleep, that's a very rare occurrence. So let's go back and remember, on average, how often corrections come. There have been about 14 between 10 and 20% corrections since 1965. There have been another 11 corrections of more than 20%. So how long does it take to fight back to even on average? Well, for 10% corrections, it's about 4 months. For 20% corrections, those are full bear markets. It takes at least, on average, about 24 months. The markets get hit all the time. And this, again, is important to remember. On average, the market corrects 5%. And remember, that's been over a year and a half since this has happened. Dow drops over 1,000 points on the week. Markets finally awake. Again, none of these corrections ever feel good. You don't root for one. You're not cheering for the market to go down. But as you know, it's to be expected. We went through I'll give you a quick history of correction frequency update. Historically, markets, if you go back to 1928, this helps us understand the average timeline for corrections. On average, we get 5% corrections every 10 weeks. We haven't had a 5% correction in over 400 market days. That's over a year and a half. So, giant departure from history. 10% corrections on average happen every 33 weeks. Again, we haven't had a 10% correction for over 500 trading days, over about 2 years. We haven't had a 20% correction for over 2,200 trading days, almost 9 years. But on average, we're supposed to get 20% corrections, or at least on an average basis, every 2 to 2.5 years. Let's call it 2 to 3 years. So, of course, we are certainly overdue for a correction in a period of time where we have seen an unprecedented lack of volatility. An unprecedented lack of volatility. And to some extent, it makes sense because we had an unprecedented level of volatility going through the great financial crisis, when our economy almost completely collapsed at the end of 2007, all the way through 2008. In the beginning of 2009, we got out of the recession, the summer of 2009, and those were dark economic days. And of course, the market was an absolute mess during that period of time, and we have come a very, very long way since then. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.